In the last week, the market has sold off 3%. And there is a lot of fear in the market now. Whether are we actually in a bubble now? There's news going on about that Michael Berry has a short position on broad tech markets, on the tech stocks, about 1.1 billion in shorts. People are worried about valuations, amongst other things. In this video, we're going to break down if we're actually in a bubble and should we actually be concerned, and if the market is going to crash. Now, why should you listen to me? I was mentored by the Institute of Trading and Portfolio Management ex Goldman Sachs traders Anton Creel and Edward Scheck, and the portfolio manager of Dragonstone Capital, based out of Singapore, managing $3 billion. In addition to that, I have completed multiple specializations and have also created my own algorithm which is running in the markets, which has generated me over a 7,500% return over the last 15 years, all of which you can find in the bio. The recent volatility in the market wasn't caused by bad macro data. The numbers actually came in fine. We had a mixed PMI and NMI number. Consumer confidence looks stable. The one issue is that we have a softening labor market right now. The Fed Chair Jerome Powell also recently came in with a statement last week where the tone was slightly hawkish, where he said that cuts in December's aren't actually necessary and you shouldn't guarantee that that's probably what's going to happen. Now, I'm going to go on a slight tangent over here talking about a wide misconception or like a wide confusion in the market right now. People are talking about we are at all-time highs. The S&P keeps making new highs. Everything looks pretty rosy. So the growth is great. Why are we still getting rate cuts? Now, the problem is because of the jobs data and unemployment. The Fed knows that AI is coming. I didn't buy into the hype that AI is going to take jobs, but it's actually true. I've seen the data and it checks out. AI is eating up a lot of jobs and AI will quite literally take over the world and replace human beings, at least most of them in not very significant job roles. Now, because of that, people are going to lose jobs. The Fed has priced that in. And because of that, the Fed is going to continue to cut interest rates to soften the blow on the job market and jobless claims. That's the reason why we're getting cuts while we're at all time highs right now. A lot of people are so confused on Twitter, X, everything. People are like, why are we getting rate cuts? We really just don't understand what's going on. That's the logical answer. The Fed is cutting rates because it's scared what's going to happen in the future with unemployment. That's a bit of a side tangent I thought I'd add in this video to give you context as to where we are. So, 82% of the stocks in the S&P have beaten earnings. That is the best we have had since 2021. Earnings growth this quarter is 13%, and this is the fourth quarter where we've had back to back double digit earnings growth. Revenue growth is 8%, which is the strongest it's been since 2022. All 11 sectors grew by revenue, and the S&P's forward PE right now is 22.7, which is higher than the 5-year and the 10-year average, which is why there's a slight scare in the market and people think that it's going to mean revert. Now, the other thing is Mag 7's forward PE is trading at 24 to 31 times. The rest of the S&P is trading at just on an average of 20 times forward PE, and the average of the S&P overall is 22.7 forward PE. From this we know that Mag 7 is higher. The forward PE of Mag 7 stocks is higher than the average stock in the S&P 500 excluding Mag 7. When the valuations are high, good earnings is not good enough. Prices and earnings pops move based on expectations and earnings beats relative to analyst expectations. Now, we already have most of the Mag 7 stocks priced at such a high price to earnings ratio, anyways, where even good earnings isn't good enough. And we saw like Meta corrected 18-20% right after its earnings report. That was another reason. That was because their capex spending is very high. But you get the picture. The expectations going into earnings was obviously sky high. Even a good beat or like even a good report, strong earnings doesn't necessarily guarantee you that the stock is going to move greatly up or significantly in your favor upwards after its earnings report. It's not guaranteed that a stock pops right after its earnings because it's trading at such a high valuation where even a good earnings beat isn't good enough. So, what do I think is actually going to happen? I think we're going to get a slight correction of 10 to 15% within the next 6 to 12 months, as I've said in previous videos. And Morgan Stanley and Goldman Sachs actually came out with a statement last week that we are expecting a slight correction in the market in 6 to 12 months. And that is actually not necessarily a bad thing. That's going to get the valuation of most tech stocks and Mag 7 down. And look, a high price to earnings ratio just means that price has gone up much faster than the company's earnings, right? So we want the price to come down, catch up, cool down a little bit, correct maybe 10-15%, which is actually going to be healthy. And we take things from there where the market isn't overheating and we have great scope for upside in that situation.